GetCrack. Wake up, motherfucker.
To perhaps the top story that is shaking the markets about 10 minutes away from the European Open, and that is this tariff story, this countdown to Donald Trump's Liberation Day next week. For you, what is the canary in the coal mine here? What is the trade that people are putting on or taking off?
Yeah, morning, Kriti. So it's, our reporters have obviously been speaking to macro fund managers all around the world to try to get a consensus view on that. And I think that two things emerge from that are pretty clear. One, that everybody has been scaling back risk in recent sessions. And of course, you can see that in declines in the equity market, widening credit spreads, the rally in gold, those kinds of things. But also, it seems that quite a few of them are still of the mind that this is going to be an opportunity to buy a dip. That people are looking to come out of it with, a surprise kind of a rally or an opportunity, or maybe it won't be as bad as you thought. So I guess if you're looking at where the balance of risks is, that could mean that if Trump is as aggressive as, he's been promising in a lot of the rhetoric, bar the last few days, that could still trigger quite a negative market reaction because perhaps people aren't quite prepared for that at this moment in time.
Paul, what's the bigger event next week? Is it the tariff story or is it payrolls?
I think the tariff story on a global scale is a thing that everybody is ready for and paying attention to. Yes, okay, the US economy is kind of important and what the Fed does is going to matter. But even then, I think that the market is focused really on what that long-term tariff risk is, even for things like inflation and the labor market that the Fed will need to pay attention to. If you look at, say, the US yield curve, we've got this steepening of the 5s, 30s, which shows that people are pricing in higher inflation for longer. That's spread at the widest in several years now. You've got break-evens widening back out. And again, like I said, the gold trade, which could also be seen as an inflation protection measure. So I think that people are worried about the stickiness of inflation, and people are worried about, if the labor market starts to deteriorate as well, what that looks like in terms of the sort of magnification effect. But what people are really focused on is what's the damage from the tariffs going to be to the US economy, and can Trump put it off, and will it be okay?
Well, Paul, we've seen a lot of habit, I have to say. I'm very sorry. But, Paul, we have to talk a little bit about perhaps what is priced into this market. So much of an expectation of those set tariff story. Is that going to show up, for example, in the PCE data later today?
So I think that people are looking for a little change in the PCE, which is, you could read it as, okay, so it's been moderating very slowly, or it's still sticky and holding up. And I think that what the Fed speakers that we've been hearing from recently are fixated on is the idea that it's not coming down as fast as they would really like, and therefore they're going to be keeping interest rates on hold for longer. We heard that overnight from the likes of Collins, Barkin, I beg your pardon. And so that, all things being equal, would see them not reverting to cuts anytime particularly soon. And that would be, kind of not for the economy as those tariff effects
higher in March. Joined now by Paul Sankey of Sankey Research here. It is interesting because we're leading the show with tariffs and the consumer and a slowdown, and oil's sitting at $70.
Yeah, I mean, the market's kind of in equilibrium right now, but as you know, OPEC still has barrels to bring back into the market, so that incremental supply that starts in April is a concern.
In like a couple days.
Yeah, exactly. And then, of course, you've got April 2nd as well in a couple of days, so there's major concerns about tariffs. And a big one for oil would be steel. Steel prices going up would actually raise the price of oil. And it may just be that oil is actually repricing as a hard asset here. You would normally sell it into a recession, as you're implying. But if we're talking about a weaker dollar, which we think we may be, then oil naturally would go up typically, although it's a really complicated question right now.
So do you think then, just spitballing here, that a 25% steel tariff might negate a 25% potential auto tariff? I mean, do we really care about auto tariffs also when it comes to oil? Because maybe just people are going to drive their older car, which gets worse gas mileage longer. I don't know. Well,
I'll tell you one thing that's a mega story that hasn't been as high priority as people should be.
Well, we're on national TV. Feel free to share it.
Is the 5-minute charger by BYD. That if that's really going to happen, and we're going to really have a 5-minute charge EV, then one of the biggest problems that we see for refining here is U.S. gasoline is declining, Chinese gasoline is declining. So both your biggest markets are declining. So it's a tough one for refining, I think. But the natural gas story, the AI story just keeps coming and coming. And so we like natural gas.
Yeah, and it seems like nat gas over oil has been the way the market's been rewarding certain stocks. And places like, talk about all services, because, you know, OFS has really underperformed, especially E&Ps. And it seems to me, Schlumberger, name I'm long, has been doing it about as efficiently as they could be. They're not back to where their earnings power was about 6 or 7 years ago. What are your thoughts?
We don't like them. I mean, we just think that the need for capital discipline, which is being exacerbated by the new administration here, just makes it a very tough group. And as you know, historically, they had a premium multiple because if you grew the oil price, their revenues grew by 1.2 times. We just don't see that anymore. And you've seen this week Shell cutting its capex to below the low end of the previous range. You know, the list goes on. We had Diamond back on our call last week. Again, he's talking about capital discipline and no growth. Northern Oil and Gas guy, Nick O'Grady, very impressive CEO on our call today as well. Capital discipline is absolutely now ingrained in what is a group of companies that are much better managed, much more attractive than they were historically. Shell, by the way, has a 15% free cash flow yield.
Yeah, I love it.
So, Paul, when you look at it, so Tim brings up services, but when you look at the complex, Hess, Chevron, ExxonMobil suck all the air out of the room for obvious reasons for the deal. Should you go downstream, upstream, or do you sit here and say, if oil comes in, can the stocks still perform?
Well, they've all got buybacks. I mean, the thing about what Brian's saying about 70 is a good price for these guys. 60 is not. You know, so you're right on the cusp of what, as I just mentioned, would be a 15% free cash flow yield for Shell. Exxon, Chevron, Conoco, Shell pretty much are in the best shape I've seen them in my career. So these big guys are looking really good. And there's a group of sort of mid-cap, more levered U.S. E&Ps which are really strategically challenged by the lack of inventory that's developing in the U.S. So the good news for the oil balance is that you're not going to see any growth this year, in all likelihood, and you're probably going into decline. When we get that point, the bull run is on, and at that point is when you want to be talking about your more levered.
Random question. I asked him, and of course he dodged. He would. Wael Sawan, the CEO of Shell, earlier this week, I had him on Squawk Box. You think there's any chance Shell buys BP?
We always thought they should merge. Perhaps John Brown's old idea was...
Yeah, maybe bought is the wrong term, but the two kind of sitting there flailing.
Yeah, I mean, I think at the moment what we're waiting for is for the activist, Elliott, to come out with an actual statement of intent about what they want BP to do, and they haven't done that yet. I think, you know, you could see a mega deal. I could see Chevron Conoco. I could see, you know, one of these very big deals getting done under Trump, too. So don't be surprised if we got a huge deal. I wouldn't be.
Yeah, I want to drill down on Chevron. If you could just kind of explain the move that we've seen this year, I think it's up 14%. Do you think that's more a reflection of people's perception around oil prices or a move in sentiment to more free cash flow, dividend-paying type of stocks?
Both. I mean, it's idiosyncratic because they started this huge project in Kazakhstan, which has been 5 years coming as a vast mega project. Actually, Kazakhstan is 400,000 barrels a day above its OPEC quota. That's being driven by Chevron. Then you've got very high conviction now that they're going to buy Hess. They've been actually buying Hess stock in the market because their conviction is so high, so people like that. And then, as you say, basically, one thing I've never seen from an oil company is these guys proactively announced a 20% reduction in workforce. Normally they do that, you know, at the bottom. They don't do it when everything's going great, and they just, you know, hit the idea of a 20% workforce reduction. So, again, it speaks to what I'm saying about Exxon, Chevron, Conoco being in the best shape I've seen them in my career.
Falling in overtime after reporting earnings down about 6.5–7%. Dana Telsey, CEO of Telsey Advisory Group, maintained her buy rating on the stock ahead of earnings with a $445 per share price target. And she joins us now. Dana, I want to get your thoughts on this because they beat on top and bottom line. It looks like same-store sales were softer than expected. Gross margin was better than expected, but the guidance disappointing.
Got it. And Morgan, thank you for having me. This is exactly what we've been seeing from a lot of the other retailers. The fourth quarter comes in better, and then you're divorced from 2025 and the guidance. One of the differences in the guidance that Lululemon just posted, they talked about a 6 to 7% increase in sales in the first quarter, and for the year, a 5 to 7% increase. A lot of the other companies reporting need a big acceleration in order to be able to hit the guidance for the year. In addition, the guidance for EPS for the first quarter is still pretty decent guidance compared to last year. It's within the band. It falls short, though, of the 272 consensus. And what I want to hear on the call in a few minutes, product newness, innovation, what's going to be driving that going forward. I want to hear about the improvement that they saw in the U.S. Is it continuing? Because you did have improvement in the U.S. in the fourth quarter compared to the third.
It's interesting, too, because some of the other retailers and apparel makers that we've seen take down their guidance have done so factoring in the possibility of tariffs. But, and correct me if I'm wrong, Dana, but Lululemon is not as exposed to those tariff dynamics based on where it manufactures, at least according to where we are getting tariff policy right now.
That is exactly right. They are not as exposed. It's a low percentage for them, very minimal. But we'll have to hear exactly what other costs are they incurring. Is there anything with marketing? Is there anything with other supply chain costs like freight? Let's hear what it is, and let's see how the business quarter to date in the first quarter is doing, because that 6 to 7% that they have is a pretty good number compared to the others.
How much does China matter? I realize it's a market that's growing, but it's growing off of a very small base for Lululemon. That said, I've had a number of conversations with a number of CEOs and executives in recent days and recent weeks who seem to be very constructive now on the Chinese economy coming back.
Well, one of the things for Lululemon is they just did an investor day back in the fall showing what the opportunity is in China over there. So it's going to become an increasingly important part of their business, as is international. As is international, which just delivered a 20% sales increase. Which just delivered a 22%.
The Fed should open the possibility of hiking rates again.
Well, it's not my base case, but I think the probability on that is rising slightly here. This wasn't that radical of a data release here, but I do think that possibility is rising. We really haven't made any progress on getting core PCE inflation down, let's say over the last year. I think the man on the street would look at those numbers and say, no, it's basically been flat for the last year.
Jim, one thing we've heard repeatedly from some economists is this labour market's just not as tight as it was. And because it's not, that dampens down the potential for second-round effects from the inflationary kick-up that you get from tariffs. What would you say back to that? How fertile do you think this environment is for second-round effects?
I don't know. Come on, unemployment insurance claims, ridiculously low. That's your best week-to-week indicator. Unemployment rates, if anything, is probably below the natural rate for the U.S. economy, but certainly low by historical standards. I just don't see it right now. Now, there's fear of the future and what might happen, and we know that the last tariff war in 2018, 2019 did cause a slowdown in the economy, and that the Fed did react to that by lowering the policy rate. So we'll see if that history repeats itself here. So that it's the expectation that people might be thinking about. But as far as where the labor market is right now and whether that's disinflationary pressure coming from there, I don't think so.
Jim, can we have a best guess from you? Next move, cut or hike? What would your best guess be right now?
I still think the committee can stick to its baseline that there will be further cuts, but they're being pushed farther and farther out into the future. And now with a hotter core PCE year-over-year number, you might start pushing those out into 2026 instead of 2025. We'll see what the market does in the days ahead.
Yo, what's up? What's up? It's April 1st, April Fool's Day. What's up, guys? Let's see what's going on here. Let me do some cycle work first. Let's do some cycle work first. And let me look at this inflation number here. So the sticky PCE updated March 12th. So that was half a month ago. Okay, so we're at 3.5. All right, so sticky CPI, sticky inflation from the Atlanta Fed So we're still pretty up here. We're pretty up here. We haven't really done much. Well, we're kind of slowly going down. All right. So I guess that's some improvement, but yeah, this is going to be very slow to fix. It's going to be very slow to fix. I don't know how this will translate into what the Fed will do, but obviously the Fed will try to keep it as high as possible. Now, let's look at how the cycles look here. So, NASDAQ, let's see, NASDAQ 100. Could be a bottom. Could be a bottom already. That's what I'm wondering about the next 3 days. Okay, guys. So the next 3 days, it's going to be crazy, I think. So tomorrow we'll have the fresh tariffs for the retaliation tariffs. Okay, that'll be number one from Trump. And then on Thursday, we'll have the ISM service PMI numbers. That'll be important. We had manufacturing today, and that was a little bit weak. Okay, but the market kind of shrugged it off a bit towards the end of the close. And then we'll have Friday, we'll have the payrolls numbers. Okay, pregnant with oh my God, you're pregnant with triplets? Man, this is a bad economy for that. Godfather. Oh shit. That's a lot of work. That's a lot of work. We'll see. We can discuss that later. Virgo. Anyway. Okay, so let's see what the S&P says. I think the similar. Yeah, similar looking thing. Yeah, it could be close to a bottom or already hit a bottom. So, yeah, who knows? But if we look at the daily, I mean the hourly. Okay, this is the hourly. Those two are daily. The hourly S&P 500 cycle chart. It looks like probably April 10th will be the optimal time to expect something. So that's 1 week away, about a little over a week away. So closer to the tax day, right? So let's see, tax day is on a Tuesday. Okay, yeah. So April 10th, probably Thursday, maybe April 9th on a Wednesday, somewhere there. But let's say Monday is a bad day. So usually Monday is a pop up or crash down. Yeah, April Fools. Yeah, thanks, Virgo. But so this is gonna be bad. Maybe. So I'm kind of wondering. I'm kind of really skeptical what's gonna happen over the weekend, this weekend. So I'm watching. I'm gonna be watching how things go. But I think that will be a place to start buying. So then that's when I'll start my Substack, and I'll start throwing out something over on Friday into the weekend, maybe some kind of list of stuff that we should look at. Definitely oil and gas. So that's why I played one of those videos. Oil and gas. Getting close, very close for here. Oh man, so this could be a bottom already for oil, but I'm not 100% sure with the dollar as it is. Dollar is going to start rising, I think. So that's going to affect gold too. So I'm going to play a gold video later on. So I think gold is about to top out. So probably maybe tomorrow or into Friday, maybe you'll see a pump in gold. And that'll be the time to think, hey, maybe it's time to dump everything, every position you have on gold, silver, all that stuff, and think about shorting. Okay, so if you're wanting to short, that'll be the best, because shorting a commodity is real good money if you time it right. So when commodities hit their tops, they go down real quick. And this one here is the small caps. So this one also aligns with the S&P and the NASDAQ. So they're kind of like all telling me, yeah, we're at the bottom. We had hit the bottom on Monday, or this could just be like the prelude to the real bottom coming next several trading days. So probably on the Monday right after the weekend, huh? How about that? So I'm thinking about that. I'm thinking about it. All right. See what else we got here. Oh, I'm gonna read this article later, probably. So I'm gonna play some more videos, but I think the videos I'm gonna play now are gonna be on China. So I'm gonna look at China a little bit. So let me look at the chart. China's open right now. I think it's down again. So Chinese stocks might be going down some more in the coming week or two. Okay, so this might be the chance for you guys who didn't get into BYD or some of those Chinese stocks, like, hey, you know what? It's time. It's time for me to get in, right? So that'll be the second chance this year to get in. So let's see where we are. Or you could short, you could short some Chinese stocks. That's no problem with that. So let's see. HK33. HK, they don't have the HK33 anymore? Dang, if TradingView got rid of that, I would be pissed. Dang, it's not here anymore. Or is it HSI? Yeah, maybe I just misspelled it. HSI, blah, blah, blah. HSI. See, Owanda. Was it Owanda? Blah, 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 blah. Was it HS? Sang. Dang, they might have gotten rid of it. Oh, man, that's really annoying if they did that. Well, that really sucks. Because that chart was quite useful. I have to use this one now. Man, I don't want to use this one. Dude. Yeah, I got to make a new chart now because they got rid of that. Yeah, I think they did. Oh, boy. Man, why'd they do that? These guys always doing something. Yeah, they must have got rid of it. Man, that's really annoying. Yeah, that's really annoying. So now I have to redraw all my stuff again. Oh, well, luckily I streamed everything, so I could just screenshot it and redo it. But anyway, let's see how the Hang Seng's doing then. I'll just have to use this one. Okay. Or should I use the futures one? I guess I'll just use this. Yeah, whatever. Oh, no choice. I'll just use this futures one. Okay. So I guess I'll have to think from memory. Okay, so we have this bottom here back in 2022. We got second bottom 2024 in January last year. We move up, we pull back, get back up here. So now it looks like we're about to move down. Okay, so I'm gonna say, what's the best spot? This is an important area here. This line here, all the way back from 2020. All right, from the crash, COVID crash. So I'm looking for a good spot to get back in. So let's see what Chinese stocks are doing well right now. Okay, Tencent is one of them. All right, Tencent. Baba is one. Okay, Baba. Let's see how this one. Yeah. Okay. See if it gets back to 100. I don't know how bad it will react to the tariff stuff. This thing, yeah, BYD, yeah, if you got in around here, 60 whatever, you got up to 100 something. Now you're looking, hey, okay. So I'm going to have to do this where I have to figure out what the price target is for this sucker, and then we're going to go do it. Okay? We're going to have to see. And then JD, is that, no, that's one that's not that good. TME, so this Tencent Music, maybe. Tencent itself. Okay. Yeah, Tencent might go down to 60. So TCEHY. All right. So watch these guys. Kingsoft Cloud. It's my favorite. Ooh, it's already pulled back a bit down to 13 from 20. Okay. See if it gets back to 10. All right, KC. All right. So let's look at the KWeb. KWeb's still stuck here. So this one is the ETF for the tech stocks for China. Okay. So let's see how that goes. So I'm going to play some Chinese videos here when they talk about China. Okay, so since it's related, and I'll go check out if TradingView really did get rid of that stuff. All right.
Me now is Strategy Risks CEO Isaac Stonefish and Blue Shirt Group Managing Director Gary Dvorchak. Isaac's firm specializes in China risk assessment, while Gary leads Blue Shirt's Asia practice, supporting U.S.-listed companies from the region. Gentlemen, it's great to have you on for what I suspect is going to be a very robust discussion here. So, Gary, I'm going to start with you because, yes, we had CEOs in China meeting with Xi and other officials this week. But we also know we have all of this trade policy and tariff talk swirling in the background as we look to April 2nd next week. And we've seen other things, other duties implemented in the meantime. So what does this mean for U.S.-China relations and the companies caught in the middle?
Well, Morgan, thanks for having me on. The meeting today, I wanted to take a few seconds and put it into some context, and that is that the Chinese government has very few options now to stimulate the economy. China's in a depression. There's absolutely no doubt about that. And they're also in a pretty nasty bout of deflation right now. So everyone knows real estate values are down, but everyone is getting pay cuts across the board. I live there, right? So I talk to business owners, talk to people, everyone's salary is being cut, businesses, their volumes are down. So everyone is really struggling just to make ends meet and to keep going. And so the standard playbook for the Chinese for economic recovery or growth is exports, right? And that would have been tough under any circumstance, but now with the tariffs looming, that exporting your way back to growth and a more robust economy is going to be very difficult to impossible. So they need internal consumption to pick up the slack. And how do you get that when nobody has any money? Prices need to go down just to create some stimulus. And so I think the Chinese government rightly is looking at every single option. We saw Xi Jinping met with Jack Ma a couple of weeks ago. He's trying to show the love to the domestic tech industry, which hasn't been feeling it as much the last few years. And they really need the tech industry to revive. And you need external investment, right? So you need these companies to up their game in China and make more of a commitment because they don't have a lot of other choices.
Yeah, the meeting with Jack Ma was particularly notable to me a couple of weeks ago. Very symbolic, given the dynamics with Jack Ma in recent years and the fact that he sort of fell out of the public eye. Isaac, how are you advising clients and companies right now, given all of these dynamics swirling in the background?
Companies are trying to stay out of the spotlight. They don't want to have a target on their back from Trump or from Chinese Chairman Xi Jinping. And so usually that means making sure what you're doing in China isn't going to raise eyebrows from what Trump wants, but also Secretary of State Marco Rubio, National Security Advisor Waltz, the issues that they might have with certain American companies and global companies' performance in China. For President Trump himself, it's a lot more on, I want to make sure companies are investing in America. I want to see those big top-line numbers. Companies are understanding that, and so they're spending money or claiming that they will be spending money in the States. We saw that with Apple. We saw that with TSMC. I'll just add, I was very surprised that Apple made its $4 million donation to Zhejiang University, like basically every university in China that is a school that is owned, operated, and overseen by the Communist Party, and that got very little attention in the debate. But it seems like those types of partnerships with the Communist Party are still today seen as normal.
Been on a week-long charm offensive with global CEOs as trade tensions with the U.S. have been rising, but somewhat in the background. Eunice Yoon is live in Beijing with the very latest. Hi, Eunice.
Hey, Kelly. Well, China's week of wooing U.S. CEOs, among others, peaked with a 90-minute conversation with President Xi Jinping. This meeting had more than 40 CEOs, 7 speakers shared their views. The industry most represented was Big Pharma. But unlike last year, when the Americans dominated a similar discussion with President Xi Jinping, this time European and Asian executives were also invited. Now, President Xi repeated the same message that we've been hearing all week, and that is that China is the steady and stable partner in the world. President Xi had warned of countries, quote, erecting tariff barriers without mentioning which country that might be. He also said that embracing China is embracing opportunity, and he called on the international CEOs there to fight protectionism. Now, despite all these pleasant words, there are several executives that are still quite skeptical of whether or not President Xi Jinping has had a change of heart when it comes to foreign businesses or private businesses, for that matter. One of the trade war timeline that people are most looking at is the April 2nd date. And that is when President Trump is going to be unleashing the Liberation Day tariffs. And already, just in the past couple of hours, the state media has been threatening what they describe as resolute countermeasures against those Liberation Day tariffs. Kelly?
And it does seem a little sort of dissonant. I don't know what the word is, that, you know, you have Canada and Canadians furious at the U.S. right now, while China is courting, you know, our CEOs. And I take your point that maybe it was, you know, more directed at European and others this time around. But has the tone there generally been, in a way, more constructive than what we've seen with some of our other trading partners?
Well, it's more constructive in that the Chinese, I think, see an opportunity here to be able to take advantage of some of that frustration that the Canadians or the Mexicans or many other countries right now feel about the what's being seen as a kind of inconsistency when it comes to the tariffs. So the Chinese are trying to say that we're the responsible ones. President Xi is the elder statesman. We're the ones that really keep the market open and want to have your trade. But of course, this also comes the same week when China announced that it released the Chinese staff of the consultancy Minsk Group, who had been detained. And a lot of people saw that as kind of a signal to foreign investors that you could still do business here and not have your people detained. But I don't know whether or not that's really convincing a whole lot of American CEOs or other international CEOs yet.
Yeah, no, it's kind of a low bar, but still an important symbolic and actual gesture. Eunice, thanks. We always appreciate it.
All right, guys. So let's look at Lululemon, since I played a video about Lululemon. Now we're still in this range between 260 and 365, and we've been doing this since the COVID days, right? We've been going around it a few times, like in the 2021 blow off. So this last big surge here was like an overshoot in that bull market, and we had another one in 2023, and then it fell through in March of 2024, and that earnings started going down all the way to the bottom. So yeah, Lululemon's a good stock. I guess you could trade this range for a while, but I think, you know, the next time we hit 260 and we go back up, this probably will be the last time it does that. Once you see that, you know, Lululemon is kind of like this white girl ETF type of stock. Whatever stock that has high dependence on on white women or just women in general, they will lead the economy. When you see these stocks start failing hard early on, maybe you'll see the economy suffer in about 6 months to a year. Okay, so last year, I think it was last year. I don't know if it was early this year, but I was talking about makeup stocks. It could have been early this year. Maybe it was earnings seasons, and we were talking about it. I forget. But here's the list of makeup stocks, right? ELF, Ulta, EL, L'Oreal, yeah, that stuff. Wait a minute, is that a stock or did I just misspell L'Oreal? Okay, anyway, let me see. Let me check. Yeah, maybe I just cut off the L there for some reason, but it's LRLCY anyway. So let me look up these things for you. Let's look at Estee Lauder, right? EL. Look at that. This has been going down since 2022. Pretty early indicator, right? And we're right back to where we're in 2012. Not good. Not good. So this thing's been suffering. Probably nothing. Probably just like it's just this company, you know. But then let's look at the other ones. Let's look at Ulta. Okay, it's in a range. It's struggling here. So maybe when it comes down back down to 300, watch how it does. If it just collapses let's say next earnings season, on May 29th when it has earnings. See what it reacts. If it can't hold this area and starts dropping below it, okay, that's a sign. So let's look at that. Another one. Let's look at ELF. Okay. ELF. Okay. Yes, last earnings was terrible. So this thing definitely has broken down. It already failed in the summer here on this earnings. It broke the trend from 2022, and now it's doing this. So definitely something that confirms the bad outlook. And then let's look at L'Oreal, right? LRLCY. Okay. This one's been in a range. So this one's pretty much in a range. Okay. So let's see. So 94 is probably where we see a top here. And let's look at the top from just before COVID, right? So this area. So we're kind of bouncing around. So let's see what happens if it gets to 60 or something and then breaks down. Once we see that, then we know something's up. Okay, that's one indicator we can use. All right. Now, the other one, of course, is like XLY over XLP, a ratio. So look at how discretionary spending versus staple spending. So how something like Tesla versus something like Colgate. You're always going to need toothbrushes and toothpaste and shampoo, right? You're not going to need to buy a new Tesla, right? That's discretionary spending. So when you look at stocks like that over stocks like that have Colgate or Unilever that have to deal with more staples type consumption versus discretionary consumption, then you can use this ratio XLY over XLP and you can figure out, hey, something's up. And this thing has been going down since beginning of February. So this was already before the stock market started moving down. So you already could sniff out something was bad. And this was mostly because of Tesla. So Tesla kind of has an oversized influence on this ratio, but I'll still use it because like it's quite useful. So this one right here, November 2021, right? You see this thing was starting to move down, and that was before 2022 bear market correction right there. So definitely we have to watch this too. So a lot of things we can watch ahead of time and see. And then there's other ones that I've mentioned, like the advanced decline line of bonds. I think that's very important to look at the bond market. So I haven't gotten around to looking at that yet because I have to like manually get the data and then put it into the Excel spreadsheet and manually create the indicator that I need. So that's more annoying. That's more work. But I don't think the bond market is that messed up yet. You'll definitely notice. So if we want to look at the bond market, you look at the corporate bond market, look at the high yield bonds. Okay, look at high yield bonds, junk, JNK ETF. So you can see, like, I think you can see a lot of panic probably here, right here. See, probably around October of 2018. That was when things started really sliding down again, right? So far, it looks like it could be in a panic, but I'm not gonna say it's gonna start like dropping like this. But definitely, that's something that you have to watch. I think you can also use a ratio like JNK or HYB is the other ETF that, or HYG. I think, yeah, HYG is another ETF that does the same thing. And I can do it divide by LQD. So I can use this ratio. So let's look at this ratio. So look at this. So October, right? It starts slamming down and you can see it still kept dropping into 2019. So this ratio itself, okay, so let me put it in the chat for you. HYG divided by LQD. So you can use this. It's a rough approximation, okay? Because I don't have Bloomberg Terminal. If I had Bloomberg Terminal and I paid like thousands of dollars per month for a subscription, I could look at the bond market in detail and try to figure out, hey, something stinks in the bond market. And when something stinks in the bond market, you can see this thing was going down in 2019. And 2019 was a crazy year because the market was going up and down, and they couldn't decide where to go. And then once we went into 2020, what happened? We had the last move up and then it crashed, right? So you see this thing here just before like the lockdowns, you see January, February 2020, this ratio was moving down. What was the S&P doing at that time? It was going up. So I could put another scale here. Look at that. See? So let me do this for you. So even though this ratio was moving down, all right? So this thing was moving down. And then the market made a nice new high just before the lockdowns. So something was fishy in 2019, definitely. And then going to 2020, definitely something was fishy because the bond market didn't like something. It didn't like something, okay? And a lot of it was because of the Fed and probably also because of COVID towards the end of the year. Because you have to know, COVID was already in China and people reporting about it in December. And if you were looking probably in Chinese media or social media before that, people were already getting sick probably around, let's say, October, November. Okay. So yeah, you can probably sniff out problems here. And you can see in January, this ratio has been going down. Now, is this a panic yet? I don't think so. Okay, but so that's why I need to get that AD line for the bond market, corporate bond market. So this is a corporate bond market. This is not this doesn't include the government bonds. Okay, this is the corporate bonds. Corporate bonds are like gives more interest, and some of the corporate bonds are higher risk, right? Let's say I get a GameStop bond. A GameStop bond would be high risk, but I would get a fat yield. I would get like 10, 15% for holding a bond for GameStop versus holding a bond for like Apple or IBM or something like that, right? So if I can look at the bond market, and bond market people are richer and more informed, well informed, so they have more insider trading, because they need to know, right? They're buying a lot of bonds, all right? So, and they're not going to be like the stock market. Stock market is cheap. Okay, and crypto is even cheaper, right? So the access to the market, to the bond market, is a lot higher. Okay, the barrier to entry is higher. That's what I'm saying. The barrier to entry is higher. So the bond market tends to be smarter, and the best way to get bond market information is you got to pay money for the Bloomberg terminal. So I can't do that. I don't have that access. So all I can do is give you what's public. What's public is I can use these ETFs. I can use the data that they provide to be from FINRA, put in the Excel sheet and give it to you and try to figure this out. So for now, I don't think there's a problem, but definitely as we get closer to 2026, I want to look more towards the bond market to tell me, hey, there is something wrong here. Something stinks. Okay. For now, don't need to worry about it too much, but I just give you an idea that that's where you should be looking for in the coming months. Because if anybody comes around on CNBC, keeps talking about a recession, this, that, dude, none of that information is useful. I need to figure out where exactly the real top is. We could be going sideways and going whatever, and it's still fine because the real top could be coming in 2026 or late 2025 this year, right? That's it. Okay. All right. So let's read some article here related. Okay. I'm going to read this article. I think this will be useful for you because this is a very comprehensive article from Tom Bowley. All right. Okay. So let's look at this. Okay, so I'm going to put the link up for you guys. Okay, this was written yesterday. All right, March 31st. S&P 500 drops quickly to test key support amid rising volatility. Okay, so here's the link. Okay, here you go. So this Tom Bowley here. So he's generally a bull. Okay, he's generally bullish on the market because for the most part, the markets are more likely to be in a bull mode than a bear mode. Very few times are we in a bear market. But we have to recognize when things are about to change, and things might be changing, okay? All right. Okay, I'm going to skip this stuff here. I'm going to go right down here to the big picture. Okay, the top portion of this chart is a PPO. PPO is just MACD, all right, with just percentage versus price. That's the only difference. Don't worry about that. What he's highlighting to you here is that when we get a consistent monthly, I think this is monthly, right? This is monthly, I believe. Yes, this is monthly. When we get a consistent monthly PPO here, okay, this is default settings on stock charts for the PPO. So when we get a consistent monthly positive, so most of the time it stays positive, right? Very few times it touches below, but usually when it hits zero, it goes back up. Hits zero, goes back up. Here we're still fine. We're still fine, right? So when we're in a bull market here, it'll last. All right. So last time we've been in a bear market, a real secular bear market, meaning that it doesn't last. Okay, so secular means that it will last for years. Okay, at like 5 to 10 years, something like that. So last time we had it was a .com, right? So this .com time. Oh, this is the dot. Is this .com? Oh man, let me see. Yeah, this is the .com into this. This is actually going all the way to the 1930s. All right, this is the Great Depression. All right, never mind. All right, he's going real old. He's going real far away. All right, and then the 70s. So Vietnam War, this stuff right here, bear market, Great Depression, then bear market and into the World War II, and then we had the 50s and 60s. All right, then we go bear market again, like we have Vietnam War, right, and then the oil crisis, right? Oil embargo, Israel doing all that stuff. And then we have a bull market, right? From the 80s, bull market. And then you have the .com, right? So George Bush time when we got the invasions of Iraq, and then we're going sideways. So bear markets, you can see it's like it doesn't go down, right? When you zoom out. When you zoom out, it doesn't really go down, except for the initial drop. So the initial drop is painful. You go up, you go back down, right? And then you have the Great Depression is probably like the worst bear market because the drop from the high to the low is crazy. So a lot of people were just buying any kind of dumb stock they were during the lead up into the Great Depression. And when that thing burst, it was like a bubble bursting. All right. And then now we had the .com. Yeah, it feels bad when you're at the top and you go down. But when you zoom out, you look, you see from that point into the Great Recession, when we had the whole like mortgage-backed security blow up, Lehman Brothers, all that. When it went down, it didn't really go much lower than the .com drop. So at that point, so yeah, it sucks when you keep buying at the top, but you can see this point here, this whole area, we were still quote unquote in a bear market from that .com .com time. So what happened here was that oil, gold did well, commodities did well during that time. So that's why I kind of keep shifting and keep telling you, hey, look at natural gas, look at oil, because we're about to end the tech move up. So the AI stuff, yeah, okay, it can go up for a few more months, 6 months, 8 months. But apart from that, we're going into the time when gold, oil, those things will start moving up. Okay, so we have to prepare for that. All right. Anyway, you can go read this yourself, okay, at the link. I put the link below. So the monthly PPO and monthly RSI are both moving lower now. But remember, we have not ever seen a secular bear market that did not coincide with a negative monthly PPO and a monthly RSI below 40. I believe we'll see this market weakness end long before we see either of these technical developments on the above chart. So yeah, we're still in a bull market. Okay, we have to go on that assumption for now. Now let's look at the ratios. So just like I did HYG over LQD, what that was high yield bonds versus stable, more conservative corporate bonds. That's the ratio. But here we just look at the ratio of the NASDAQ 100 over the S&P 500. So if we look at that here, the top portion, we take out the gaps. So this is a little bit more complex. Tom Bowley likes to do this. So this is a custom indicator that I made. What he did was he went through the charts and removed the gap moves. So when you open and close on a day, right? Okay, a trading day, you could open up, jump up, open at a higher level than you were at the close, and that's a gap. Or you jump below, right? You go down lower than what you closed in the previous day. That's a gap. He takes that out. So if we do that, what happens is we see that we are at quite a lower low right now. Now, if we keep the gaps, okay, this is traditional because this one you can do yourself. You don't need to manipulate the data. You just get the QQQ divided by S&P. If you look at that ratio, we're just back here, okay, back where we were in this green zone. So this could be where you buy a bottom, and this is a lower low. So what does that tell us? Relative weakness in the QQQ over SPY, including and excluding gaps, has turned back down in a big way. That's not what you want to see from a bullish perspective. We must remain on guard for potential short-term downside action, especially if key closing price support at 5,521, that's the S&P 500, fails on the S&P 500. Okay. Now we do the same thing for the IWM versus the NASDAQ 100. IWM is the Russell 2000, the small caps. So we can see small caps have been weak. That's no surprise. It's been that way since Jerome Powell opened his mouth, and small caps just took a big hit from that compared to everyone else, right? So we're still quite low here. Okay. I think there was something today or yesterday too about what RFK did. So RFK Jr., he did something about, there was some news. Yeah, he fired somebody, and it really made the XBI. So the biotech portion of the Russell 2000 went down pretty badly. Small caps seem to be performing better than the aggressive Mag 7 led NASDAQ 100, but that's not saying a lot when you look at the IWM's absolute performance in the bottom panel. Perhaps we'll still get the small cap run that we've been looking for over the past year, but it'll likely need to be accompanied by much more dovish Fed, and with the short-term Fed rates falling. So yeah, that's not. Yeah, this might be something, but it might not even have any effect until probably April. I mean, not April, October. Okay. So I'm not going to be optimistic about that. Now, here we go. XLY over XLP. Remember, so discretionary over staples. Tesla's over toothpaste. Okay. So this ratio here, all right, ignoring the gaps, pretty dang bad. This is really bad. We cut down below this line here at the 90. Now, if we have the gaps, okay, we're still in this range. I guess that's okay, but still, now you just went above and you went back below that line and you're in the range again. No, that's not a good look. So what I told yesterday is that I think we are going to be sideways for 7 months at least. So again, I think October. Okay. So if you're looking to get back into high tech and things like that, no. Sorry, Palantir is done. Okay. So for you guys from last year, when I said don't bother with Nvidia anymore, go to Palantir. Palantir did you well. It treated you well. But if you want to say, hey, you want to get back into Palantir, like I told you, I was selling in February. I said, I am done with Palantir. Okay. Palantir had the earnings. We got up to 120. I'm selling the rest of the month. And guess what happens towards the end of February? Down, 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 down into March. Okay. And if you think Palantir is just going to rip right back up and get to a new high, no. I mentioned last week that this chart was the biggest positive of the prior week. I suppose I now need to say that it's the biggest negative of last week because it did an abrupt about face. It appears that the options expiration and oversold bounce we enjoyed for over a week have ended. We haven't broken back to new relative lows, which would be obviously be bearish, but we did back a lot of ground that we had previously made up. The XLY over XLP ratio is one of the most important in the stock market as far as I'm concerned. Watching it turn back down is not a great feeling, and an upcoming relative low would only make it worse. Well, let's look at the price to put to call equity ratio. Okay, I mentioned this one before. Okay, we're moving back up. All right, let's see. Okay, yeah. So, okay, we made that low. Sentiment indicators are contrarian indicators. When they show extreme bullishness, we need to be a bit more cautious. And when they show extreme pessimism, it could be time to become much more aggressive. Major market bottoms are carved out when pessimism is at its absolute highest level. Okay. So yeah, we're not there yet. We're not there yet. We gotta hit that 0.75 level extreme pessimism. So I feel like the next 3 days might be it. And if it doesn't come, then wait for Monday. Monday might be the big one. Okay. If it drops hard on Monday, then we got to get ready to buy everything up just for that bounce, at least a good bounce into May. Okay. So that's why, yeah, we got to be watching. Okay. Okay. Blah, blah, blah. All right. Let's see. Yeah. He's going through a lot of stuff now. Okay. I think you can read these ones yourself. I'll read these paragraphs here though. Okay. When an elevated CBOE volatility index VIX sends a signal that we could see pain ahead, which is exactly the message sent recently as the VIX approached 30, I usually turn my attention to a rising 5-day SMA of the equity only put to call ratio CPCE to help identify market bottoms. Once the stock market turns emotionally and begins to show fear and panic, key price support levels tend to fail, and a high reading in the VIX combined with a huge reversal on the S&P 500 think capitulation usually are typical ingredients to establish a key bottom. We're finally starting to see some higher daily CPCE readings, which suggest that options traders are growing more nervous. And that's a good thing if we're going to try to carve out a meaningful market bottom. The last 4 days have seen readings of 0.65, 0.71, 0.72, and 0.68. That's not quite high enough to grow more convinced of an impending bottom in stocks, but it's light years better than what we've seen during any recent market sell-off. Okay, let's look at this one. We're coming to off an extended run higher in the benchmark S&P 500, where we topped on February 19th. The long-term picture with sentiment is much different than it was 1.5 to 2 years ago. Back then, everyone was bearish, leading to an important market bottom and a subsequent rally to new all-time highs. We could use more bearishness in options to set us up for another rally to all-time highs. Based on this chart, we're not there yet. So yeah, we are not there yet. So this one could probably mean that October, right? So we'll get a bounce in the coming days, but that won't be the real one. It'll just keep us in the trading zone. All right? That's all that means. It doesn't mean like we're done with this. So expect us to go back up and expect us to go another back down, right? From September or maybe August, September into October, something like that. All right, so I'll let you guys read the rest of this some other time here. Yeah. Okay, so I think I talked about the VIX enough already in the past few streams, so I don't think I need to cover this one. All right, let's see what else we got tomorrow. Tesla will report quarterly deliveries. Okay, so let's see. Tesla should report first quarter deliveries on Wednesday, and analysts are projecting the lowest quarterly performance in more than 2 years amid public backlash to CEO Elon Musk's involvement with President Donald Trump, and as the EV giant rolled out its refreshed version of its best-selling vehicle, Tesla Advance Tuesday. Analysts in recent days and weeks have been hastily revising lower Q1 delivery expectations ahead of Wednesday's release. Along with first quarter vehicle delivery data, Tesla will also post Wednesday Q1 production figures as well as energy storage deployed. The company is expected to see Q1 vehicle deliveries increase 5.4% to 407,900 as of FactSet estimates, which have declined 10% since January 31st. However, Tesla Investor Relations compiled delivery consensus numbers is 377,592 based on several analyst estimates. That would be the lowest since Q3 of 2022. Okay, the most timely delivery estimates are between 315,000 to 369,000, which would be well below Q1 2024's 386,810. Tesla demand in China appears to be on pace with a year ago, according to Tesla insurance registration data. However, Tesla vehicle sales in the U.S. and Europe seem to have dropped dramatically, according to independent trackers of vehicle sales. All right. Troy Teslike, whose delivery estimates and Tesla data tracking are highly respected among retail Tesla investors, on Monday posted to X he believes Tesla deliveries will total 355,000 in Q1. Okay. So, what my guess is that it's going to be bad tomorrow morning. But guess what? Bad news, when you get the worst news possible and everyone's already bracing for it, if there's not anyone willing to sell Tesla stock below a certain amount, let's say. So let's see. Tesla today closed at just 268. So my resistance level is 283. Okay, so it's closed at $268 and nearly 50 cents. So around 283, 284. Let's see what happens there. Okay, if it either makes a new low tomorrow with the Trump tariffs, or it'll try to push up towards that level, then yes, 286, watch that. If it can break through it, then we're done. Then we might be clear. But if not, then yeah, watch for a new low, okay? And then see where you want to buy. Because that's where it will be, probably into Monday, I'm guessing, if Tesla reacts badly like that. Okay, let's see. Anything else? Because yeah, these are great stocks to trade. Okay, so nothing else here. Okay, I'm done. All right, so let me play some video here. Let's look at the market overall picture. All right.
Quarter of 2025 is in the books. The S&P 500 finished down 4.59%. It was its first losing quarter in 5 months. We're going to talk about the S&P 500 on today's video. We're going to look from it from a larger perspective to a smaller perspective. We're going to get into market conditions. We're going to get into expected moves. By the way, it's a new quarter, new quarterly expected moves, new monthly expected moves as well. We're going to get into some signal charts, cover the Sailor to Shift tool, Bitcoin, and so much more on today's episode. These episodes are brought to you by my partners and my patrons. If you haven't checked out Interactive Brokers, make sure to do so when you click the link in the pinned comment or the description. Check out that Interactive Brokers campus where they have a host of free tools, resources, and courses, you name it, from beginner to advanced, some great stuff in there. And yes, my patrons in the community, it's only $9 a month. We offer a whole host of benefits within that $9, which I still plan on making a video. One really great one, which is this little guy over here, is an entire set of Tradie Tick bots, as well as the query channel where you can type in various commands and get Tradie Tick data sent to you about instantly right there in the Discord chat. Let's go ahead and get into today's show. All right, people. So the market's been selling off a little bit, but today, if you watched market net flow, this was a clear tell sign that it was an amazing opportunity to play an intraday bounce. So we started off in the SPY, gapping down in the market, and we saw continued sell side press lower. Now, as this was occurring, market net flow was rather bearish, but really early in the trading session, the green line started to uptick. Guess what? And the red line started to continue to go down, and this was happening right in and around that lower daily implied move for the S&P 500. And for the bulk of the trading day, we found ourselves moving higher after what seemingly looked like a very scary market open. We're going to dive more into that in moments, getting those new expected moves. Let's take a look from a broader picture, and that's the quarterly chart. So every candle here represents 3 months of trading data, or 1 quarter. By the way, when a quarter ends, what that means, Earnings season is back, and we're going to start with them financials. So as you can see, the S&P 500 was down 4.59%, which is not all that bad when you look at the last 3 months performance of the heat map of the S&P 500. And what you see here is rather scary, right? You get the Nvidia that's down in bear market territory, the Tesla that's almost cut in half. You have the Google that's in bear market territory. The one that's holding up the best so far would be Meta at only minus 4.47%, but this came quite a ways down from its early in the year boost. You have Apple that's down 14% and Microsoft that's down about 14 to 15% there too as well. Now, as we're looking at the quarterly chart, the 5 EMA over here, you can see it typically holds as a level of support, and we came into it and we bounced from it. So when it gets a little bit scarier, right, is if we start breaking the low of the quarter and we start to move down further, and this starts to potentially start to decline, which we've seen here in the 2022 bear market. You can see when we broke it over here in 2020, that was the pandemic. Christmas Eve massacre over here was in 2018, and it's very rare to have a couple of closes underneath the quarterly 5 EMA. I don't have the 2008 financial crisis, but typically when we start closing underneath the quarterly 5 EMA, you've seen countless times where the Fed does some sort of intervention and or something bigger catalyst drove the move underneath that larger EMA. Now, if we look at the monthly time frame, also not the greatest look, right? We're talking about this price percent oscillator. The percent price oscillator has been curling over here to a bearish crossover. And we looked at that monthly candle last month, and it was somewhat of a doji candle, and we cracked below the low and we started to flush lower. So this is not the greatest looking chart overall as far as the recent candle formation being down 5.75% on the month. So if we start bouncing up higher, pay attention to around 5,800 to 6,000. That was that candle low right over here of the prior month. And then 6,000 tends to be a little level of, one, a psychological level, but two, it was just about the high of this prior month. If you zoom out on the weekly chart, we do see that these divergences have started to play out. We've seen this a lot of times, right, where the market presses higher, but our internal show weakness. The market pressed higher, our internal showed weakness, or our internal showed strength while the market got weaker, and that was actually a more positive divergence. When you look at the MACD over here, it's basically pointing straight down, so we can get bounces for this to start flattening out, but just be aware it's not the greatest look from a quarterly to a monthly and to a weekly chart, given the context of all this volatility. Now, if you zoom in on the weekly time frame, you can see that we came up into the the weekly 5 EMA that was declining, and then we reversed back down on Friday's close and had some follow through today, and we close a little bit higher. Remember, it's very common to tag these EMAs, right? When we got stretched down here, we said you typically get some sort of a snapback. So more bullishly speaking, you'd want to see this 5 EMA start to turn back around and start to trend higher. If you look at the daily time frame, it tells a little different story, right? We sold off rather hard. We bounced up into a prior area of resistance. And then now today we put in another low, a new low, which we know when we're talking about follow through days, which the S&P 500 I guess technically didn't get one, but we gave it some wiggle room because it was still happened to be up 1% with higher volume than the prior day on, I think it was day 4, but we didn't technically get it. But now the count starts over with a new low. But as this is happening, what did we do? Well, we undercut this prior low. We closed up towards the high, and we have somewhat of a positive divergence in the MACD and the RSI forming. So if we see this bounce up, where can we potentially go? I'd still, once again, pay attention to around that 5,800, which kind of lined up with some of those other levels that I mentioned here on the monthly time frame, about 5,800 to around that 6,000. So 5,800 would be that first level, would be looking right around here. Now, that would actually surprisingly follow the script of 2022, right? Where we 2021 going into 2022, we sold off, we bounced up, we sold off, undercut the low on a big reversal candle, and then we went higher, and you could see that we actually took out this high over here before reverting back down. So I'm not saying that this is going to be the same situation that happens, but I want you to just be mindful that in the realm of volatility, these are the things that can typically happen, and it brings a whole lot of excitement on the way up, and then people are just like, we're going back to normal. This was it, right? This was the bottom right here. And then we didn't, right? We went down for another 2 waves, this one and a following one there shortly after. So when I look at the S&P 500 now, well, we sold off hard. We bounced up. right? This happened to be right at the all-time high anchored VWAP. We sold off, and today we had somewhat of a reversal candle. So what would that look like if it kind of follows that same path? Well, we could get some follow through, maybe go lower, and maybe potentially break this high. And the same situation means that we'd revert back down to some more sell side activity. I'm not calling for that, but I think that that's what we need to be aware of. And the way that we can adjust and move throughout this process is by paying very close to what the market's pricing is as far as risk, so expected moves, and the market conditions when they change back, right? And we'll talk more about market conditions here soon. Now, if we take a look at the S&P 500, this is the SPY looking at this entire year. I have some lines on my screen. The orange lines are weekly expected moves. So we got a new weekly expected move. It's about $14.25 plus or minus. I'll give you those levels momentarily. And then last month, our monthly expected move, we closed just outside of right over here. We spent a lot of the time doodling around. And then the last trading day we closed right here, the last trading day on Friday, but then we ended up closing up slightly higher. We closed slightly outside of the monthly implied move. So I'm going to be updating you with those levels. You can see even today, we came down into the quarter to date expected move. So we traded well within what the market priced in for the quarter. However, slightly there outside of the month. And then as far as the weekly expected moves go, we've been tagging them every single week, except for this week right here. So 1 week out of multiple weeks. So if I update you on those levels, where do we stand? Our new month to date expected move for the SPY is 532.12 to the downside, 586.66 to the upside. So if we were to play a very similar type trade that I was mentioning over here that looks like 2022, or maybe we rally up, perhaps start to pay attention to that monthly expected move, which would bring us above this high and potentially get us into what the month price in. That's a possibility. Now, be mindful that this is the end of quarter, end of month, right? We have the JPM collar trade come on, and it's typical to get some sort of window dressing, it's called, where you get a rally up. So we don't know if this is a trap or not, but if you got some exposure, where would be a safe bet for a stop loss? Under that low. It's pretty much that simple, right? You don't need to overthink it. Now, if the market continues to sell off, where's our quarterly expected move and lower monthly expected move? 532.12 to the downside, 513.95 to the downside. So this is what the market's pricing in for the quarter Q2 in 2025. All right, a couple other interesting charts that I want to just make you aware of that we've talked about in prior videos were these larger term monthly charts. And I just found this to be interesting that we've been in this channel since coming out of the great financial crisis, 2011, larger term monthly charts.
All right, so I'm gonna go back here. I'm gonna go back here to this chart.
Be a safe bet for a stop.
So I think you should screenshot this. Okay, so like I said, we're moving down. Okay, now our expected moves are moving down. That's normal. I think that's how it is. And all the option guys are already planning this kind of new range here at a lower point. So be aware. Be aware. So let's take a screenshot of these levels. You see the quarter to date, month to date. That's it. Yeah, go for it. Go for it.
Loss under that low. It's pretty much that simple, right? You don't need to overthink it. Now, if the market can, we come to this upper portion of the channel, and this is, by the way, Dow Jones Global Index. And you can see we just rally into these levels. Sometimes we overshoot it, like after the pandemic, and we got some big stimulus, but then we started selling off. And when we sold off into the lower levels, well, the Fed typically has stepped in at some point, right? We had Operation Twist. This was some global growth scare. We had Christmas Eve massacre over here. We had the pandemic. This one's obviously a little bit different where we had, this was the bottom right here was actually the highest inflation print. And now we're back up to these levels. So what happens if the market starts selling off, right? Once again, I'm not calling for that to happen, but if it comes down into these levels, that's a big move for a global index. And you can see over here, we do have a divergence forming on that percent price oscillator. If you take a look at the IWM on the monthly chart, same situation. This is dating back to 2000. We come up into these areas, and we've had a pretty clean channel overall, and we're not looking all too hot right here. So if the IWM continues to sell off, make sure that you're paying attention to this confluence here of the lower trend line and this other prior level that acted as resistance and then support here. Now, once again, I don't know if that's going to be the case if we're going to reach down there, but if we were to reach down there from a larger term perspective, those could be good opportunities to start to really build in longer term positions if the market conditions allow for it. All right. So that would be some key levels from a larger term perspective that we may or may not come down to. I don't know. Now, while this is all going on, you can look at the relative strength lines for safety assets, like for example, gold relative to SPY, been going super high right over here. It's been trending higher. Utilities relative to SPY, right? Boom, ripping up higher over here. Consumer staples relative to SPY, it's been trending higher. TLT relative to SPY, it's been a while since we got back above the 50 EMA and started inclining. That's been doing good. Healthcare, defensive names, all been doing good relative to the S&P 500, which tells me it's more of a risk-off market, but there are still some things that have been working overall. Now let's get into the market conditions of this market right now. First and foremost, I like to look at the gamma flip line. I'll do that before we talk about the JPM collar. The gamma flip line right now is at about 57.50-ish, right around there. And that's underneath that all-time high anchored VWAP, which we had some resistance in. Today, we came down into and around this 5450-ish level, 5500 level, and we started to bounce from that. That happened to be a 0 date level that we're eyeing in on earlier this morning, and we rallied up higher. Does this mean that like all systems go? I mean, it's just a little bounce up. Like that's all this is. We had a nice big bounce up here, and that ended up getting fading too. So remember, stop loss would be down here at about 5,500. Okay, now if I continue on, this market has been in negative gamma here for like 30 trading days. And this is why it's so important to know this, because your strategy kind of has to change if the market conditions change, right? If you're used to buying breakouts and the stock's tightening up and it breaks out and you buy the breakout, and you're used to it in positive market conditions, meaning that we're above a gamma flip line, that's how you're used to seeing stocks respond. And it can respond like that still in negative gamma, but there's more likely scenario is that you get fake outs, bull traps, whipsaw moves before it starts going. It's not as clean. And this is coming from just years of kind of watching this and trading. You really need to understand what conditions the market, first off, how you determine market conditions.
I like this like presentation here because yes, as a trader, you need to understand what condition you're in, right? So the previous 2 years, it's a bull market, really strong, very clean. So when I see Palantir break out, I know it's going to keep going up. I buy. Or like you do HIMS, right? HIMS. You go like, hey, when I traded HIMS this first quarter, I saw like, hey, it's going to 30. And I bought more. So I was already in at 20, 25. But once it broke 30, I bought more and it's zoomed to 70, right? I didn't know it was going to go to 70 or whatever it was going to do. But the chances of it going to a higher level was much better during that period. Now, after we got through February, what happened? It ain't doing that no more. So we can't. So things already got worse, right? Last year when we got Powell talking in December, right? He basically said, I only care about inflation. I don't like what Trump is doing with tariffs, whatever. I'm going to do what I need to do to worry about inflation. That's my goal. Now, this year, we got the inauguration. We got more tariff talk, all this stuff. Yeah, Antoine. Yeah, HIMS, great. That was great stuff. And SoFi, like, a lot of those stocks, they're similar. SoFi, a lot of those growth stocks, very high growth stocks. What happens now is that we are shifting, right? We are moving to a regime where the tech stocks, they won't act like that no more. But what's not being explained here is that, like, there is going to be something that will act like that. What are those stocks going to be? That's gas, oil. So gold, silver, like those things will go up and act like that now. So we have to shift. We got to shift and go to somewhere else. If you're doing the growth stocks, you got to short them, right? Look at AOI. AOI, it bounced. It bounced strong. And then when it got close to resistance, it just crashed. It just crashed hard. So, like, if you wanted the short stocks, you look for the point where, like, oh, yeah, look at this stock moving up, right to resistance, short again. Short it again. And you just keep shorting. So that's how you got to think about it. So this is where you learn. And once you get that, then you're really going to do well. Okay. So Anyway, let me continue this.
Conditions, right? That would be one. And then what strategy of yours works best when those conditions change or when you're in a different environment? So for me, I like to be a breakout trader, BO, breakout trader, when we have positive gamma, when we're above a flip line, and when we're above rising 5-day moving averages. That's the two very simplistic things that I look at. So what happens if we're in negative gamma? What do I do right now? Like, right? Well, you can look back at my tweets just recently. On July 31st, I talked about this. I talked about the bull trap and how things were potentially changing and how we could potentially see a bull trap, which ended up playing out. But when this happens, what do I do? So my strategy changes from breakout to fading, right? I'm not much of a short seller personally, but when we're in this type of regime, I end up, what this means is typically you get more volatility, right? So when you're in negative gamma, right, volatility typically increases. So this is important to know, right? Liquidity dries up. You get wilder price swings. And what environment works best for that? And also underneath a 5-day moving average. It's not just short selling. It's also, right? It's also waiting for very big extensions and playing short-term bounces, right? And also day trading. So instead of swing trading, your time perspective changes as well. So intraday trading, or you're holding names for a little bit shorter periods of times, or you're looking for things that have gone down significantly and you're looking for specific bounces and then you're selling into those bounces. So that's how my strategy changes here. And that's how I've kind of managed to withhold my gains so far this year, right? They started off in January doing great, right? I was up 9% for the month for my portfolio, which this is all, by the way, I put this in the United States Investing Championship, so you can look at my results in there. I was up 9%. Then in February, I took a haircut down to about 5%. And now I'm sitting at roughly at about 11%. So I'm at a new portfolio all-time high. I managed to kind of withhold some of that volatility. And on a couple of bounces and a couple of fade trades, we managed to make that back. So that's how I approach these markets. And that's why the conditions are so important. I'm telling you right now that what I just went over is probably the most important aspect to all of this, is understanding your strategy and when it works best. And I never hear YouTubers or anybody really talk about this. Unfortunately, they'll talk about R multiples and various things and position sizing, right? They get into some nitty-gritty stuff, but very rarely do they have a way to determine conditions of market. So that's what I do here. Okay, if we look at back month versus front month volatility, it's coming back down below 1.0. Remember, this is typically where we can potentially find some sort of basing, where we see a bounce, right? It can get extended, which we've done before, right? When we got down here prior, we said this is typically where the market tries to find some basing or found some bottom. If you just go straight down like so, you can see we came here, we came a little lower, then we bounced up. Right now we're coming back down. We've just been going sideways, and now we're back to an extended reading there. This is happening while we're back in backwardation. So that means front month VIX is higher than over here in the May contract, the June contract. So what does this mean? In short, right, instead of doing the terminology backwardation contango, it says, hey, we got problems right here. Right now, this is where volatility is at. Okay, until this looks like this, right, you got issues right now. Okay, so deal with it. Now, JPM did come out and they put on their collar. For those that don't know, there's a good Seeking Alpha article out there that kind of walks through what that is, how they buy out of money puts and so forth. So if you want to screenshot this or just look up the Seeking Alpha thing. In short, it's just what they wrote was, it's a strategy that involves holding an underlying asset while simultaneously buying protected put options and selling call options. So if you want to read more about it, please do so, right? So you can understand it more. Overall, what's my thought on this, right? When I pull it up and look at it, it's just a large position, right? And this JPM caller right here, it kind of looks like they're just neutral to market for the most part, right? The upside over here is 58.80. Then we have our long puts over here at 52.90, and then we have our short puts down here at 44.60, okay? So to me, this is not a huge change by any means, but because of its size, it's important to just be aware of it. For the collar strategy, right, it's to protect people from downside, right? But it also kind of limits that upside potential. But being as it's so big, like last quarter when we came up to it, it can act as somewhat of a ceiling, right? As dynamic hedging kicks in up at these levels, price can get pinned and potentially push away from it, which is what we saw last quarter. That doesn't mean that we can't break above these levels and press higher. That's not what this means, but it's just to be aware of these specific levels in the market.
So I want you guys to screenshot this too, okay? Screenshot this You have all these new levels here. So we can go down to 5290 now, right? That for the S&P 500. That's a potential now. All right. And I think I can look at my chart itself and see, let's see, SPY, let's see. So I have it at 537 to 540. That's one level. So this one's just below that. Okay. And the next one will be 512. Okay. So that's higher than this 440.60 level. So 44.60 level. Okay. So anyway, screenshot this too.
Because they happen to act like levels of potential resistance, potential support, right? And they can act somewhat like magnets when price gets around them. So those are the levels. You can put them on your chart. If price gets to it, we'll be talking about it on this channel. We talked about the 5-day moving average, the direction of it, SPY-Q, IWM, semiconductors, biotech, DI, all down beneath that as it stands right now. So it's all declining. So what does this mean? It means that the market has some proven to do, right? Not only do we have to get back above the flip line, but the market also has to say, hey, we got to get back above this and start making it trend higher again, which we just are not doing. We've seen some pockets of positivity, but overall, it's been flat to declining. And then on top of that, these blue lines, those are the year-to-date VWAPs, okay? So those are going to come into play here at some point, most likely. I don't know when or how, but we're going to have to watch those lines because those have the potential to become now resistance as price is currently below them. If we take a look at CTA positioning, still massive short positioning here. So when these things potentially change over, hey, maybe that's when we get some sort of real press higher, but they have been net sellers. Vol Control Fund's been net sellers. If you want these charts, take a look at Gamma Lab, right? I always share this. They give my people the code MSD50. This is, I don't think he works with anyone else other than me at this current moment. It's only $14.99 a month for this dashboard, and you could build it how you want to. It has a news feed, all types of cool data from option metrics, systematic flows, COT positioning, various context charts. You can't beat it. I even export the levels and put them onto TradingView, all kinds of cool stuff. And you get 50% off of your first month if you sign up for the $14.99. So check it out if you haven't. If you don't like it, I mean, you're out $7 or $8 or whatever it is. Okay. So let's continue on now and look at the expected moves. So the SPY, right? We saw a nice little clawback today, ended up being positive on the day. Woohoo, hey, woohoo. But we still have a lot of work to prove itself. Coming into tomorrow, our daily implied zone comes down to in about 551.52. If you want the exact zones that I put on my charts, screenshot and put them on your charts. Or I give the daily expected moves in the Discord community. Okay, and I post the 2 sigma levels there too, every day for the dailies. And then the weeklies too as well. I post all that stuff there. So the upper level is about to and around from 565.50 to about 567.26. Remember, we have a new monthly expected move, and this is actually pretty interesting to me. The upper monthly expected move is in confluence with last year's closing price. And as we've talked about this last year's closing price, as a price has memory, if you're new here, then you don't remember this, but we talked about this level as a very important level on the Qs and in the SPY, and when it came down to it, it acted as support and then bounced. It came up, it acted as support, and it tagged it multiple times until eventually flushing through it and seeing some sell side. So if we come up here, not only do we have the upper monthly implied move, right, but we also have last year's closing price, which can act as a potential level of resistance as well. So those would be the levels that I'm watching, right? And the upper weekly implied move is about 570 to the upside, 541.41 to the downside over here. So that's what the week is being priced in here going into the first month of April. We take a look at the Qs. The Qs weekly expected move is right here about 454.37 to 483. We're flat on the trading day, right? It started off kind of scary, but we closed up pretty much unchanged. Going into tomorrow, if we start moving up to the upper daily implied zone, just be aware that we're below that declining 5-day moving average still. Okay, so these levels can act as potential resistance, but if we start breaking above it, then what? Well, we start to look for that upper weekly implied move. And we have the upper monthly implied move up here at about 497 and the lower one down here at about 441. Okay. I know people will look at this and say it's a bear flag. I would agree. But also, right, having this big of a reversal, maybe perhaps comes up, comes down, shakes some people out, and eventually we start to move higher. These are all possibilities and potential paths, but there's nothing that you should be extremely certain about right here, given the context of being below a declining 5-day moving average, right? And then also being negative gamma. So it's shorter term trades. And if you are playing various, or how I'm going about it at least, if I do play into the market, it's shorter term and or I'm fading extreme moves for a short period of time. Let's hop into some of the signal charts. Not much is going on from a signal chart perspective. I do want to call out the bullish percent index for the NASDAQ. It looks like it's potentially going to give us some sort of a bullish divergence here. So as the comp kind of move lower, you can see that we're kind of matching lows around here. So maybe if this rocks a little bit lower, we have an RSI that's putting in a higher low. So that could give us a positive divergence. We saw that here. We saw that here, both trying to mark some potential bottoms right over in these areas. So that could be something to watch more bullishly speaking. From a summation index perspective, this did click over, so we're kind of chopping around over here. And we don't really have an extended reading in the Nasdaq McClellan oscillator, but we did get a lower reading today. The old full indicator right now, still on a sell signal, sell trigger, right? We talked about that when that was crossing over. It's typical to see bounces, which we've seen before. And this one, it remained in a sell signal and we started to sell off. So until this starts to turn back around, by the way, this is a big lagging indicator, but it still catches some pretty big trends in the market. We've seen this multiple times, right over here too. So it'd be interesting to wait to see how this looks. And when it does, it can just be an extra signal or piece that we can add to our repertoire of looking for longer term positions or potentially finding more stable bottoms. If we look at the S&P 500 bullish percent index for technology sector, pretty similar situation here as the NASDAQ composite. It's not quite a bullish divergence yet, but this looks like it's going to get lower. And this is a pretty low reading, right? This is under 15. We haven't really been here since, well, to 2022. And we do have, if this comes a little bit lower here, have a positive divergence forming currently on the RSI. So this could be also good opportunities to start to look for plain extended moves in some of the tech names and look for potential bounces. That doesn't mean that the market's going to get fixed and we're going to all-time highs, but it doesn't mean that we can't bounce up and catch some decent trades here too, if it makes sense from a risk reward standpoint. If we look at the Sailor to Shift tool, this is where we measure and map the difference between, the rate of change between Bitcoin and gold. We're still on a sell signal, right? As it crossed below here, and then we have our official trigger right over here. So we had the sell signal this week over here in January. The following week closed below the low. That's the trigger. Okay, so that's sell signal, sell trigger. The market went down, it went higher, and then we flushed down lower. And now we're waiting for this to cross back above. I'm pulling this out because, hey, we started to see it move higher, so that's a positive sign. Price action's not confirming it, but hey, maybe perhaps we cross above here. We have a weekly close above it, right? Maybe next week, maybe this week, maybe next week, right? We don't know when. But if we get back above there, then we start to look for whatever the prior week was, and we try to break above that to give us that buy signal. And we don't know if that's going to be a whipsaw or if it's going to turn into like a signal that we saw over here, and we started moving significantly higher. In fact, you can look at all the signals and the triggers here, right? So caught this September run all the way up. It caught us and saved us from this drop, from this drop, right? It caught this run up, it caught this run up, right? And it's been protecting us from this current drop that we're at. It's actually protected us from every big collapse in the price of Bitcoin as far back as I can with this stock charts data. So it's positive, but there's no confirmation, okay? If we look at gold has been on a monster move, and this definitely looks like what? What is the story here? That's my thought process, is what is the story? What is gold telling us, right? This is currency. It's a commodity. It's typically a flight to safety. And this thing has just been on a monster move. This is going to have to consolidate. Look how it consolidated over here on a big run up. It took 1, 2, 3.
Yeah, this is what you got to watch. I think we are about to hit a point. So next video I'm going to have on gold after this one.
Months to consolidate. So there's going to be a period of time, maybe this year, that we go through another 3 months of consolidation or a pullback. So just be aware these levels are getting extended. And what happens if gold maybe starts to downtick or underperform the price of Bitcoin? Well, that's what presses this price up higher and potentially gives us some sort of a signal. If I look at the absolute price of Bitcoin, we saw this kind of big negative divergence over here on the RSI. We had us cross over the relative strength line between Bitcoin and S&P 500 on the 50 EMA, and it's been holding and declining ever since, right? Then we had their sell signal, all types of things leading up to a potential sell-off over here. Not good looks, and it doesn't look all too strong right now. We do still have an inclining 200-day moving average, so the Bitcoin has to prove itself, and it has to prove itself fast, right? Other than that, it just kind of looks like it's flagging out and it's kind of taking its toll and heading lower. So if this thing starts to flatten out and roll over and we continue to be on a sell signal, sell trigger, it's just not a good look for the price of Bitcoin as it stands. Okay, so that's all I got really on the.
Now, last stream yesterday, I said for the cyclical analysis for Bitcoin, we already hit a bottom. Okay, now all I got to wait now is for the market to bottom. All right, that's what I'm waiting right now. Okay, so let me share the screen for the chart for MSTR. MSTR is my baby. I like trading this guy up and down, up and down. So let's look here. Let's look here what we got here. This is the weekly chart. Okay, we're still between a rising 40 week moving average and slight decline 18 week, and you see the MACD is kind of getting closer to zero. Not really touching there yet. So I'm watching this. But if we look at the daily, okay, little pinch, potential pinch here. We could actually hold together and move up next week. But that's no guarantee. There could be a temporary move up to 326 on MSTR and then push back down. So if you're on MSTX, you know, you've been doing good. You've been doing good so far. So let's say this is the 2X ETF, bullish ETF. So MSTR, you've been moving up here 100%. Okay, with MSTX for this move from here to here. Now, you pulled back, right? So I bought on Monday some of my positions back, see how high we get. And if things go well, okay, if things go well, I'll keep holding them. But if things don't go well the next 3 days, and Monday is a bad day, it's going to be a bad day. Maybe Friday is a bad day. I don't know. If things fail here, then watch out. Watch out. Another move down, okay? And that will be the real low. Maybe you'll go back to 20 or something, and you'll buy again, and then we're ready to move up. Okay, so you got to be careful a little bit careful here, okay, with this. So let's look at this chart here. Yeah, we're in this box. Very good. We're staying in this box between 278 on MSTR and 295. Okay, so let me look at the daily here. Yep, still in this box. So yeah, watch this zone at 324 in the coming days. Maybe we'll get a little tap on 356 and then it moves back down. Okay, so this is just for trading. All right, and if you really want to short, then yeah, you would probably plan to short when it gets back up in this area. You'll be like, okay, just like here, like let's say you shorted on Friday. This would have been a great short. Like I didn't partake. This would have been a day trade for me if I did that. Like if you saw this when it opened here, looking at the hourly chart, you see it opened here and just flushed right down to a close to 300. Okay, so let's look at the lower time frame. So let's say you got the 13-minute, 10-minute chart out, something like this. It started doing this right away, right? You would have been like, oh shoot. It opened right here. Okay, it opened right here below the lows of last week. Okay, and you would have opened a short right there, right at the open. You would have been like short here, and then you would have stopped up here at 324 or something and just went all the way down. And if you're crazy, you would have, that would have been a good day trade. But if you wanted the Monday move, you could have sold some, kept some, and then bounced and went long here, because you were right at the rectangle, this rectangle area. This is so important. So closing here, you would have to bounce here, then you would know. And then you would have had a long, or you could have just waited for Tuesday and went long. I don't know. Either way. So that's important to know your levels. Really important. Now we're back up here at 305. We're probably going to get up here. And if you want to short again, yeah, wait for it to get up here. And maybe it gets a strong move from the Trump tariffs because everyone's so bearish on the tariffs. Maybe nobody was willing to sell anymore. Everyone sold on Monday. And so this thing could probably push up higher, maybe to 356. And that's where you short. All right. So there's a lot of opportunity to keep trading these things into tax day. Okay, so next week, and then tax day afterwards. All right, in coming 2 weeks. All right, so I'm gonna start talking about gold now. Let's see what the gold is doing. Okay, so I am waiting to see how high this thing moves. All right, so let's see how high. I think gold will make a blow off top. So let's see if this moves up. And if you want to short gold, I would recommend you use GDXD gold mining stocks. Okay, so this is a 3x bear ETF. So if this thing drops to 6 to 5, 5 to 6 basically per share, okay, you can buy this and make a quick buck. All right, because when gold starts dropping, it'll drop real fast. That's how commodities move. Commodities don't just hang out at the top. Once it makes a new top and it can't find any buyers, it'll start rapidly moving back down. And you can make a quick buck. So this thing could just go back to 9 from 5, right? So let's say it goes up some more. So then GDX will go down. So it's inverse, right? This is 3x leverage of gold mining. So GDX, all right, whatever percentage here, you can do that with the ETF GDXD 3x leverage. Okay. Of course, you can use options on GDX, or you can just short some gold mining stock or something like that. Or you could use futures and just short gold directly with gold futures. Okay, just short the futures itself, futures contract. All right, so let me play the gold presentation. Okay, and then you'll see what I'm talking about. So are we at the top for gold? Oh, it won't play it because it's too big. I think the file is too big. Okay, let me see. Let me see. Oh man, that's disappointing. Okay, let's see. 306 megabytes. Yeah, I guess I can't play it today, huh? Oh, that's disappointing. Okay, hold up, guys. Let me see. I don't want to download a lower quality. Man, that's gonna be bad. But I might have to. Let's see. Gold. Let's see. See if we can download a lower quality one. All right, just hold tight. Okay, so let me see what else I can play. In the meantime, while I'm downloading these alternatives. Okay, let me play this. Let's see. I'll play one more China video here. Let's see. I don't think I played this one yet.
Big here. You've recently written about this low confidence moment in China and what it's going to take. And you've said that potentially Beijing might move to do a whatever it takes moment. Why haven't we seen policymakers take that kind of assertive action yet?
Well, first of all, we have to understand that there's a constraint here. 10 years ago, they started this mandate of monetary tightening, trying to curb the bubble, basically. And it's very hard politically to shift away from that mentality. So they are phasing in by step the stimulus package. We've already seen a rollout of pretty major packages, coordinated way, monetary, fiscal, and there will be more coming along the way, but they have to figure out exactly what works and where it would take it to the real economy.
What do you make of what do you make of the current cocktail of stimulus measures, whether that's monetary, and to your point, they've recently pivoted the monetary policy stance to relatively loose, I believe, out of the PBOC last year. And of course, they've introduced now what they're going to do fiscally. Combined, do you see a path towards sustainable inflation?
Inflation. Well,
sustainable inflation.
Sustainable inflation. Well, I mean, that of course is a focus, but you know, people's expectations really have to change. And here it involves a lot more about building the foundation again, rebuilding the foundation based on saving the real estate. They're really targeting lower income households. I think that is the major structural shift. And they're talking about reforming taxes, you know, very narrow tax base so that you don't really have redistribution. I really think that the focus on the lower income households and future employment is really important because you have hundreds of millions of rural people who have the highest marginal propensity to consume, but they don't have the proper social insurance.
That's a really big point because you have about 500 million rural workers in China. Their pensions are about a fifth of the percent of an urban worker, right? And that's a fundamental problem. It will be an enormous reform to see that change. Are you expecting to see any kind of that sort of fundamental change to social welfare over the next, I don't know, 5 years? What's the horizon that you see?
Well, first of all, if we look at fiscal policy, I think one really interesting aspect is they're focusing on what they call village rejuvenation, moving industry back into the countryside and building up a consumption community around there, so creating employment, jobs. I think you have to start from employment, and of course pension reforms are ongoing. I think that there's still some bottlenecks there because, you know, you have the hukou system that prevents migration. You have 180 million or more migrant workers without the proper access to. But I think that the industrial aspect of in the countryside and rural land reforms is actually very interesting.
Where do you see growth coming in short term? So short term this year. Do you see any pickup in consumption, or do you think exports in some way will remain the key pillar for this year?
Well, we'll have to see about the impact of the tariffs war, but of course, you know, all the talk is about consumption now, and the government is fully focused on consumption. It's just not that easy to do, right? I think that we have to separate the cyclical factors, which is people don't really have a rosy prospect of the future, and sustainable employment and wage increases. So they got to fix that first, and then you have to fix some of the structural stuff. But so far, it's been really still exports driven. And it really depends on whether China can kind of move some of these exports away from the U.S. back seamlessly into other countries.
You've also written that potentially the Trump tariffs present a kind of opportunity to China, that China has already fairly successfully globalized its markets, and that has that sort of resilience. But I suppose the other side of the coin here is that we are now seeing frustrations from other countries. We think about the likes of Vietnam, perhaps South Korea, other Asian countries who are concerned about this wave of Chinese exports coming into the economy. And Fred Newman, who I think you're speaking with over the next couple of days, has warned about this cascade of tariffs, not from the US, but from other Asian nations. So how do you assess China's resilience to tariffs from outside of the US?
Well, I think this is really a core issue going forward. It's not just about the U.S. tariffs. It's about the structural imbalance where this political economy model in China really favors scaling up supply and not enough raising personal demand. You know, we talk about social services. The local governments are more incentivized to nurture champions than they are to spend on social services. So until they fix that, there are going to be a lot of exports going everywhere. And maybe they will take up things like voluntary export restraints and things like that, but they don't shift that imbalance, you're right, there will be backlash from other countries as well.
So on that risk, do you think the risk of tariffs from other Asian nations is bigger than the risk that China faces from U.S. tariffs?
Well, I think that it's very hard to measure because everything is so interlinked and there are lots of intermediary products and it's a network. But I think that tariffs in general is going to be massively hurtful in the short run. I was talking about the unexpected consequence of Chinese companies having to find other markets. But overall, I think, though, China has kept a very firm message that they're going to keep globalization firm and even unilateral reduction in tariffs if possible.
And the other side of that is, what do you make of, you know, Donald Trump has come out, let's say, guns blazing, wanting a lot of things. And, you know, one of the comments I've heard recently is that if you really want to simplify what he wants to do, is simply rebalancing terms of trade. do you think he'll be able to achieve that in 4 years? Like, what would a win look like realistically?
I don't know what a perceived win looks like, but the first trade war did not work, the first agreement, because, look, the deficits in the U.S. is due to a massive fiscal deficit, and the surplus in China is because of the investment downturn due to real estate. So these are domestic issues that's causing this imbalance. Trade tariffs is not going to fix that.
I want to press a little bit further. What does a win look like, to your point about perception as well? What does a win look like from Beijing's point of view?
To have stabilized the situation, to not have escalated and exacerbated. Look, China's economy is weaker than it was the first time around. It is not interested in engaging a trade war. However, when it goes onto the negotiation table, it needs to be in a strong position. This is why there has to be a very robust stance. But to stabilize the situation, China does not want bad relations with, it wants a normal relationship with the U.S. if possible.
Yeah, and I guess one of the comments we've heard a lot about is, China can't control some of the things outside. What it can control, is to your point, is refocusing on consumption. And I want to get your thoughts on this younger generation of consumers, right? This is a generation, if you think about it, a lot of them were born, if not right before, right after China joined the WTO. The internet was there. They're arguably the most well-traveled generation of China. They've seen the world, they've come back, they've studied abroad, they've come back. And wondering what economic implications you think that might have for the future in their mindset. I know that's not really a strictly economic question, but it's certainly an issue that they have to think about.
I wrote a huge chapter about that in my book. I think it's fundamental. They will change the face of China because the big spenders, the big borrowers. It's only because recently the employment prospects have not been so rosy that they're unable to spend. But one click on Alibaba's Taobao and they borrow to buy a lipstick. That's their way of life rather than the older generation. So once China stabilizes, they will be big consumers, big innovators, and they will actually be a great bridge between China and the rest of the world.
Alrighty. Okay, so let's see if this video plays. That was a good piece, nice general piece on China. So you understand the dynamics that we have right now. Okay, going into tomorrow, Liberation Day. Okay, so let's see if this works. Let's see if this works now. Come on, StreamYards, play it. All right, good.
We're live. Let's talk, gentlemen. Welcome to the Foundation for the Study of Cycles. Yeah, before we jump into today's episode, let me remind you that we host this year in June a live conference in New York. And I would like to invite you to join us at this conference. So let's give it a short intro before we start into the session. Yeah, I would like to invite you. The main reason is we will be there. We can meet in person. We can speak face to face. We can exchange our views on cycles with a lot of experts there. So I would really like to see you there. On today's episode, let's talk today about cycles in the gold and silver mining sector. We didn't talk about that area or asset class for a long time. So I think it's worth an update. Once you've seen the cycles, I think you will understand why I think that's important. For those who are new to this channel, my name is Lars Fontin, member of the Foundation for the Study of Cycles. And on this channel, every Monday, same time, same place, we will do some education on cycle analysis. So the main purpose of why we're here today is to learn how to apply time cycle analysis on assets, on financial assets. That's the main purpose. We are not here to do any forecasting or prediction. That's why we always keep it the basic time series cycles projection. So hope you will learn something today. And as said, let's use gold and silver mining stock as example for today. So let's jump to the price chart first. So here we have the gold mining stocks. So the GDX as a fund here on a weekly time scale. So we start with the longer term picture. The weekly long-term cycle is at least the place where I would recommend to start always first. At the bottom, we see our cycles spectrum as always, which reveals the time-based cycles in that sense. So what we see or clearly can see is there's one main dominant cycle with a length of 240 weeks. So it's a quite long cycle, but it's very prominent here in the spectrum. So it has a very nice shoulder to the left. You see it even going down to the bottom of the x-axis, which is very rare. So this is an important separation of that cycle to all those shorter cycles here. The shoulder to the right side is not as perfect, but for this long-term cycles, I would count this as even as a sharp peak in the spectrum. So that's what we're looking for. So more to the right, there seems to be even longer cycles, but I would not count them. We need to move to the monthly or other topics here. And there are a lot of shorter term cycles, but I would use those shorter term cycles then when we move to the daily chart. So from the long-term perspective and the long-term analysis, let's go with the 240 week cycle as the main cycle, which is also seen here by our ranking score as most prominent dominant cycle. Okay, we activate that cycle as an overlay, have a close look at the correlation to previous turns in the price. So you're aware we are using that cycle for changes in trend in the underlying price series. That cycle or the shape of that cycle is not used to do any prediction in regards to major absolute price targets. I need to repeat that so that if you're new to that cycle analysis, this is not about prediction the price target range. This is used to predict the timing when we expect a major reversal, compared to the previous phase of that cycle is expected. So we expect here a reversal to the upside, and we expect here at this point a reversal then to the downside, which is, oh sorry, my graphics is a little bit disrupted here, which is what happened. And then we expect a timing reversal to the upside, a reversal to the downside, and a reversal to the upside. So you see that timing seems to be a dominant rhythm, just using time-based cycles. And if we now look at the current condition, it looks like we are approaching the topping window. Let's call it window of opportunity, of one of our colleagues in the foundation would call it. This is the area, the timing window, where we could expect the next major reversal to happen. We could expect. It does not mean it must to be expected here, but we have a high probability based on that cycle that we are due to a correction in the gold mining weekly series here. So let's have also a look at the silver mining stocks. So let's see if silver is revealing a different picture here, or if silver has a similar picture. So therefore, let's switch to silver weekly first, long-term period. Let's start with the cycles perspective first. It's not, we don't have a new all-time high, or not all-time high, but compared to the situation, silver is a little bit lagging the gold, but from the long-term perspective here, we find a similar cycle in terms of nominal length. So this is 233 weeks, but you also see to the left, and to the right in that spectrum, there is no other long-term cycle. So 233 is very close to 240 weeks. So I would count it's the same nominal cycle we currently see here in the silver mining stocks. It's not silver, it's the silver mining index, compared to the gold long-term cycle. So we can find that long-term cycle in both asset classes, slightly different, but let's see the status. And we are also here arriving at the possible topping projection for this long-term cycle now to come to an end. So let's see if we will find an end. And you also see the swings of the projected changes in trend in the past worked quite well. So I think that's the reason and the time to move now to a lower time frame to analyze if we find cycles within cyclids condition where we look out for the daily cycles, maybe coming also to a top projection in that long-term window now, because that's from a cycle analysis perspective what we're looking for. So we should never use just one cycle and one time frame. You should look out for cycle clusters when their phases come into alignment at the same point of time or in the same window of opportunity, when the long and the short-term cycles come to the same phasing, which means let's see if on the daily chart we also find topping cycles, dominant cycles, which seem to top out in the projected period from the long-term perspective. That's the basic approach. So this does not only relate to gold or silver, this relates to all asset or asset classes. Therefore, let's switch to the daily gold mining stocks now. Let's start here with the pure screen. So we see here now, which is really in an quite up move here, starting even in 2022. And as we've seen from the long-term analysis, we are quite in this long-term cycle coming to an end. And we see at the bottom here now the cycles condition for the daily cycles in that window. So that spectrum is not as easy or is not as simple as the weekly, where we have clearly seen one dominant cycle peak. Maybe we use pikel. Let's name it. Let's look out for pikels. Peaks in cycles. Can make it even shorter. So where are the pikels? Okay. Fun aside, let's look for the peaks in those cycles if they align with the current timing condition. But therefore, as said, it's not as easy because we have different cycles from the spectrum perspective here. Yeah, you see they have also quite similar amplitudes or similar condition in the spectrum here. So they are not as clear separated from each other. So there's no easy rule to decide which one out of those 4, 5, okay, maybe this 6, but this is kind of flat plateauish cycles here. So what comes into the options are those 1, 2, 3, 4, 5 cycles here in that setting. And just from the visual shape, it's not as easy to pick one or the other. So therefore we need to think a little bit more how to deal with this situation. So let's make the picture a little bit larger. So the first one, which maybe I would recommend, or let's give it a try, is this one here with the 107 days. And the reason why I'm stating that, if you look at the ranking score, which our AI-guided cycle detection algorithm proposes us, shows us that if we have a look at the visual shape in the spectrum, let's move here. So the visual shape in the spectrum seems to be the best for this peak here. And I just can assume it is based on here the left shoulder. It's clear, we have a clear separation. If you see here, it even goes down to the 0 line in the spectrum. So this is maybe also a good takeaway or learning for you here in that perspective. So when you have this kind of separation where it goes from the peak down to the 0 line of the spectrum, that's a clear indication that there is a very dominant cycle length active here. The right shoulder is not as perfect, but you see it's even coming down the same or even a little bit more than the second one here. So that's one reason the spectrum and the amplitude is also, if you just set the line here, you see to the right, so it has the highest amplitude. So it's the sharpest peak, yeah, just to summarize also to understand our AI logic here. So this is the sharpest peak, yeah, so from the shape, so it's not as flat, it's the sharpest peak. And the left shoulder is going down close to 0, and the amplitude, so the height of that peak is higher than all the other ones here. So I'm not quite sure, but as I've trained that algorithm, these must be the rules why you will find the 107-day cycle ranked as the most important cycle. And you see it's quite here in the middle. So just from looking at the spectrum and the normal data, it's not as easy as that. But therefore we have the help of also computer-guided eyes looking at the spectrum besides our humans here, which tells us this is the most important cycle, also looking at the spectrum plot using AI technology. All right, so here we see this cycle with 107 days. And you can also have a quick check here just to indicate what I always would recommend to do. So the visual alignment of those changes in trend. So here we have a bottom, which is here at that timing. We have a topping here, which is quite close here. We have another bottoming here, which is aligned to this low here. We have a high here, which is close to this timing. We have another interim low here, which is in line with this cycle bottom here. We have a topping situation here, which is aligned with this top formation here. We have 2 lows here, or 3 lows, 1, 2, 3, in the area of this timing window here. Then we have a topping formation here, at this point here. So just coming from here and then drawing a zigzag into that cyclic rhythm. Yeah, you see that those 1, 2, 3, 4 repetitions are quite close. Here, this one is off, obviously, but then you see it even resynced. So here we have another one. So that is phase off. So, but counting now the overall shape of that rhythm, yeah, you see that it's quite on in terms of the recent stability. Peter, I also see your question in the chat section. So what I just did quickly as a visual confirmation, you can also call this stability or measuring the variation of that cycle length and the variation of that cycle phase in comparison to the real cyclic price behavior. And if this variation is very low, which I just briefly have plotted here on the chart, then you have another confirmation that this is a good cycle to use for forecasting, because we want to use cycles which have a low variability. Cycles always have some kind of variability because it's the nature of cycles, but the more stable they are, the better for using them. So that's just the explanation. That's a little bit the procedure which you should always look out for if you do your cycle analysis. For sure, you can implement that in mathematical terms, but I think it's important that we always understand what is happening and what needs to be done and where your eyes should be trained on to find the picals. So this is a pical. This is a pical to use. But so, excuse. Okay, let's zoom out here. This is this is the most important short-term cycle. That's the story. Why am I explaining all that kind of work? Because this most important short-term cycle here is also looking to in the topping condition or has topped out already. And maybe now you understand what I'm trying to explain is now here we have exactly a cycles cluster of a daily dominant cycle, which is currently topping, in alignment maybe with a very early topping of the weekly cycle. I mean, the weekly cycle is close to topping, if you remember the 240-week cycle. Now here we have the 107-day cycle, which is also topping out. But this is a very interesting cycles within cycles alignment. Before moving forward, let me show you just some interesting observations, which I did here. As said initially, it's not quite sure which cycle to pick out of those here, right? You might remember this statement just at the beginning. So I tried to explain you why I would favor the 107-day cycle, but in case you're unsure or you're not sure about these, how you measure variance of cycles, let's also activate the shorter one here, 91. And I can do this by just activating or deactivating and just have a look at the current situation. Because when dealing with cycles, you should never go too much into the past, into the history. You could do that, but a perfect alignment in the past is nothing more than curve fitting. We need to understand what the current phase of that cycle or a composite cycle is. So therefore, I always recommend don't look too much far into the past or into the future than the current condition, because you anyhow need to update your analysis because cycles vary over time. So back to the screen. So activating, so have a look at that timing position, because this is now, and this is the future. This is what we're interested in here. So it is slightly moving to the left, now adding 2 cycles, but it has topped out. So there's still room to the downside. Let's now add also the next peak here, 125. Okay, it's also topping out. So it seems those 3 cycles are forming a cluster here, which topped March 2025. So which topped this month 1 or 2 weeks ago. So let's also add now the next cycle here, which is 149 in that series. Yeah, and you see this will also form in. So that's always interesting. Even if we would add now all 4, 1, 2, 3, 4 cycles into that group, you will find there's in terms of forecasting area, not really a big deviation. So all those 4 cycles stack up into a topping condition for the daily cycles right now. So it's not as important maybe to pick the specific most dominant cycle, because even all those 4, well, let's also add this one here, 194 to the mix. Yeah, it's even forming a perfect daily cycles top here. Without knowing the long-term picture, this is anyhow interesting on its own. So, I mean, we can also zoom out a little bit. You see now how nice those 5 cycles are able to explain all major changes in trend for the past 3 years. Yeah. So I would never recommend use more than 3, maximum 5 cycles. But what I want to showcase here is that all 5 cycles stack up into a possible topping condition on the daily chart. And setting this now into the context of topping long-term weekly cycle in that series brings us into a situation that from a timing perspective, the weekly cycle is now in an early topping stage. And the daily cycles, almost all dominant cycles, stack up to a very prominent cycles cluster peaking now. Okay, that's the timing of that stuff. But for sure, no one is trading time, and we cannot trade time. And no one should base any financial decisions just on pure cycle analysis. But what can be done with this timing information, and if you are a follower of that channel, by the way, I would recommend please subscribe to our channel, like our channel, because we always want to put education out here. Do us a favor, leave a comment, recommend to your friends, and please subscribe. Because if you do so, and if you are a subscriber, you are aware of the fact that once you know the rhythm of the daily and the weekly, you can use that information to optimize and fine-tune technical indicators. Sure, technical indicators are helpful, but technical indicators are more or less only helpful if you tune them with their parameters to the actual market rhythm. Otherwise, you have a lot of whipsaw in those technical indicators. And cycles are the best way how to set the parameters for technical indicators. I think this is an undervalued knowledge piece of gold. No one explains you in the world of technical analysis. So let's do that now on the GDX gold price chart, right? So let me open just a basic GDX. I'm using TradingView here. You can use whatever charting platform. It really doesn't matter. Here we see the GDX price chart on the top. But price here is not as important. Let's start with the main indicator first. Let's therefore make this smaller here. So what you see more in this chart is one of my favorite indicators. It's a relative strength index. I've just provided it with an optimized calculation. As known, if you're a subscriber, you know where to find that. It's free, it's open source, it's available on TradingView for everyone. So I'm just using a special version for making it more easy to do some multi-time frame visualization here. So it has a little bit adaptive bands and it is cyclic smooth. The main topic I want to introduce here, you tune the length and the parameter of those settings for the indicators to half of the cycle which we have just seen in our analysis section. So the daily cycle was 107. Yeah, you might remember 107 for the daily. So I use half of that length to optimize the length parameter for the daily RSI indicator. 55, you could use also 52 or 53. It's not as important. And then I'm also calculating a weekly RSI, CRSI indicator. And here using half of the length of 240. You might remember 240 was the measured dominant cycle on the weekly chart, and half of that length is 200. Half of 240 is 120. So this is the calculation, and that's the important part of the story. Yeah? You could do this with any technical indicator. Once you do that, those signals and the classical reading of those indicators get much more interesting. Just to explain, if you're new to that, the shading here, so you see some background gray shading and background red shading here, which is plotted. This is due to the fact that this is now the weekly condition. So if the signal line on the weekly is above the upper threshold, so it's overbought, then this is indicated with a red shaded background. So we know that the weekly is also in an overbought condition. And the similar other ways around, if you have green shaded background, the weekly, the long-term perspective of the cyclic tuned RSI is in the oversold condition below the dashing line. So that's the background. And then we see the standard RSI reading here. So once you find the basic signals crossing the signal line from below across the lower band in the area of green shaded background, these are the highly filtered by technical conditions tuned to the dominant market vibration. And you will look out for the similar condition when this indicator line is dropping below the upper threshold line in the timing situation with red shaded background, which means in the condition of the weekly. So that's just the explanation if you are new to that kind of indicator. And let's now have a look on past signals. So you will see here is the major bottom, and we saw here the entry exactly within that area with this indicator marked 1, 2, third time. So here had the three bullish conditions. Then another entry would have been given here and here. So that indicator spotted the major bottoms in the course of 2023, 2024. So these would have been entry signals. And now the first exit signal came here in October 2024, exactly at that point in time here. And now you see why I'm revealing that where we are today. So that's quite interesting. So this is technical analysis. But now, and now hopefully everything adds up to a story where you can draw your own conclusions. We have the weekly cycle in the early topping formation. We have the daily cycle and the 4 to 5 most dominant cycles on the daily topping out right now. Tuning technical indicators to that kind of dominant vibration brings us to a technical situation where we are now all lining up into a similar situation. That's the topic for today. Running 30 minutes. I mean, I'm committed here to do an analysis for 20 to 30 minutes. I think that's it. So quite interesting to observe the gold mining sector, long-term cycle. Quite.
All right, guys. Hopefully you got a good insight there. That went through a lot of stuff, but you can watch it again. The link is in the description. The Foundation of Cellular Cycles link I put on the chat as well. Okay, for the YouTube. And, if you want, there's also a conference in New York in June. So you could also check them out. But yeah, they also have a website, cycles.org. Go to cycles.org. O-R-G. Okay, very easy to remember. So you can go there, cycles.org. All right. I'll see you guys. It's already midnight for the Eastern folks here on the East Coast. So yeah, I will see you around. Let's see what happens tomorrow when the Trump tariffs kick in. See what he announces, see how the market reacts. It'll be quite interesting to see. All right. Later, guys. Good night.